as well. Okay, so in the exam, whenever you are going to start the question, first read the requirement, because requirement basically makes your initial idea that what you are required to do, and then you can filterize the information from the scenario very easily. So as you can see that they have highlighted the requirement, given a cost of capital 10%, what is the minimum acceptable contract price to the nearest $1,000 to be received at the end of the contract. So you are required to tell basically the minimum acceptable contract price. Okay, and it should be in the future value terms, as they are telling us to be received at the end of the contract. So it has to be converted to the future value. And Angelika, do you remember the formula for the future value? Future value is equal to present value multiplied by 1 plus r raised to the power n.
Yeah.
Yes, and for the formula for discounting is present value is equal to future value multiplied by 1 over 1 plus r raised to the power n. So this is the first revision of our two formulas. Anyhow, let's read the scenario. A company is considering investing in a 2 years project. When you are going to see this type of information, immediately you are going to make the table for investment appraisal. Do you remember making the table for investment appraisal? You are going to draw the years. Okay, horizontally on your Excel sheet, you are going to write the number of years. So they are telling you a company is considering investing in a 2-year project. So year 0, year 1, and year 2, you are going to write straight away on your Excel sheet. They say machine setup cost will be 125,000 payable immediately. So payable immediately means that this is an outflow at the start of the year, at year 0. So you are going to write cash outflow of 125,000 under year 0. Then they say working capital of 4,000 is required at the beginning of the contract and will be released at the end. So it's very simple. 4,000 outflow you are going to write immediately below to 125,000, because this is required at the start of the contract. So when you are actually investing, at that time working capital is also injected. So negative outflow 4,000 you are going to write below to 125,000, and there is no transaction as such in year 1. Then at year 2, this 4,000 is being returned back, or is coming back to the organization. So now you are going to calculate the net cash flows. So the net cash flow at year 0 is 129,000. In year 1 is 0, and year 2 is positive 4,000. Now, as you can see that the cost of capital is 10%, it means that immediately you are going to look for your present value table. Present value table, in present value table, you are going to look into the column of 10%. Discounting factor for 10% at year 1. At year 0, it's going to be 1. At year 1, it is 0.909, but it is not required since there is no cash flow in year 1 for us. In year 2, for 10%, it is 0.826. Is it, Angelika?
Yes, Miss, 0.826.
Okay. So now we are going to calculate the present values. In year 1, it will remain 129,000. In year 1, it will remain 0. And in year 2, it is 4,000 multiplied by 0.826.
3,304.
3,304. So it means that our net cash flow is how much, Angelika? 3,304, and negative value is how much?
132,304. Oh, wait. 129.
No, it is 129,000.
125,696. Negative.
Yes, 129,000 minus. Yes, it's 125,696 negative. 125,696 negative. Now, Angelika, you have to convert it into the future value, since they are requiring you to calculate the minimum amount which you need to receive at the end of the project. So you have converted it right now in the present value. Now, this amount which you have calculated has to be converted into the future value. So 125696 is the present value, multiplied by, you are going to multiply it with 1 plus r raised to the power n. So your n is how much? 2. And your r is cost of capital is how much? It's 10%, 0.10. So calculate it. It is 152093. 152093. As you are required to convert it into the minimum 1000. So what you are going to write about it, it will become how much, Angelika? 152,000.
Yeah, 152,000.
152,000 it will become, because they have told us to convert it to the nearest $1,000. Are you clear about it, Angelika?
Yes, miss, I got it.
So were you clear about this already, or do you think that you will be needing to revise the concepts again? Have you found this question easier?
I think I need to revise a bit more.
Okay, question number 74, Angelika. Which two of the following statements are correct? Option A, tax allowable depreciation is relevant cash flow when evaluating borrowing to buy compared to leasing as financing choice. This is wrong, because basically tax allowable depreciation is not a relevant cash flow. It is the tax saving on the tax allowable depreciation. We do see that how much tax saving is there, tax benefit is there on the tax allowable depreciation. Okay, so this is wrong. Option B, asset replacement decisions require relevant cash flows to be discounted by the after-tax cost of debt. This is wrong. Basically, this cost of capital is used for asset replacement decisions. Okay, we do not use after-tax cost of debt for asset replacement decisions. On the other hand, after-tax cost of debt is used for lease and buy decisions. Okay, so we use after-tax cost of debt not for asset replacement decisions, but for lease and buy decisions. On the other hand, in the case of the asset replacement decisions, we do use cost of capital instead of after-tax cost of debt. Got it? Okay, then, so both of these statements are wrong. So which means that option C and D is the right one, but let's see how is it right. If capital is rationed means that we are not having enough required capital. We do have more projects to be investing in, but we do not have enough capital. It means capital is rationed. If capital is rationed, divisible investment projects can be ranked by profitability index when determining the optimum investment schedule. This is very right. Whenever there is the capital rationing and those investment projects which are divisible, in order to rank those, we use profitability index. Okay, then government restrictions on bank lending are associated with hard capital rationing. This is again correct. Basically, there are two types of capital rationing: hard capital rationing and soft capital rationing. Hard capital rationing arises because of those factors which are not in the control of the organization and which are outside, which are being initiated from outside the boundaries of the organization. So government restriction is not in the control of the organization, it is arising outside the boundaries of the organization. So this is hard capital rationing. So option C and option D are the correct one. Okay, let's see question number 75, Angelika. As usual, we are going to see the requirement of the question first. If the company's cost of capital is 15% per annum, what is the present value of the tax saving from the tax allowable depreciation at 1st January 2005? Okay. Let's see the question now. Now you are required, what have you established that what you are required to calculate in this question? You are required to calculate the present value of the tax savings from the tax allowable depreciation. So a company has 31st December as its accounting year end. On 1st January 2005, a new machine costing 2 million is purchased. 200,000 is 2 million. The company expects to sell the machine on 31st December 2006 for 350,000. The rate of corporation tax for the company is 30%. Tax allowable depreciation is obtained at 25% on reducing balance basis, and the balancing allowance is available on the disposal of the asset. The company makes sufficient profits to obtain relief for the tax allowable depreciation as soon as they arise. Now, Angelika, this is again a very straightforward question. We do have only 2 years under consideration. Those are 31st December 2005 and 31st December 2006. And for both of these years, we are required to calculate depreciation and tax saving on that depreciation. So for 31st December 2005, first we are going to calculate the depreciation. How much depreciation is there? The cost of the machine is 2 million. Is it, Angelika? So on this
2 million.
How much depreciation is there? 25%. How much is 500,000?
Yeah, 500,000.
100,000 multiplied by 0.25. Yes, it is 500,000. So on 500,000, we are going to calculate the tax saving. Tax saving is going to be at 30%. So take 30% of 500,000. It is
150,000.
150,000 is the cost saving, is the tax saving for 31st December 2005. Now, as you do know that in the year of disposal, we are not going to take any tax allowable depreciation. Do you remember the concept? So the year of disposal is December 2006. So in December 2006, we are not going to take any kind of depreciation. So carrying value at 31st December 2006 will be how much? 2 million minus 500,000. 100,000 minus 500,000.
1.5 million.
Very good. It's 1,500,000. 1,500,000. And out of this 1,500,000, we are going to deduct 350,000. That is the sale value. So minus 350,000. It is 1150,000. Now this is basically a balancing charge, is it? On this balancing charge, we are going to take the tax benefit at 3%, at 30%. It will be 345,000. Got it, Angelika?
Yes.
So tax saving in year 31st December 2006 is how much? 345,000. Now total these 345,000 plus the previous tax saving has been 150,000. So it is now 495,000. But you have to see, they are telling us that we have to calculate the present value. Now, 150,000 tax saving has been in year 1 and 345,000 is in year 2. And our cost of capital is 15%. So let's see on 15% for year 1, what is the rate? What is the discounting factor? On 15% for year 1, it is
0.87.
0.870. And for year 2, 15% it is
0.756.
0.756. So you are going to calculate the present value of both. So 150,000 multiplied by 0.87. It is 130500. Okay, and then for 345,000 multiplied by 0.756, it is 260,820. So 260,820 plus 130,500. It is 391,320. The total saving is 391,320. As you are required to convert it to the nearest $1,000. So that is why you are going to take only 391,000.
So it's
Got it,
option A.
Angelika?
Yeah. Yes, miss. So it's option A.
Okay. Okay, now, Angelika, question number 76. As you can see, what is the expected value of the net present value of the investment project? Question number 76. Let me just scroll it down. Okay. An investment, what is the expected value of the net present value of the investment project? So they have already converted the things into the present value. That is why they are asking you to calculate the expected value of the net present value. Angelika, do you remember the concept of expected value? It is the sum of all the probable values. Okay. So let's read the question. An investment project has the cost of $12,000 payable at the start of the first year of the operation. The possible future cash flows arising from the investment project have the following present values and associated probabilities. So now, Angelika, as the cash flows are already converted into the present values, we do not need to convert them by ourselves. We are only going to calculate the expected values. So present value of the cash flows, first we are going to calculate 16,000, its probability is 0.15. 16,000 multiplied by 0.15. Then the next one is plus 12,000 multiplied by 0.60. Then plus, the last one is in negative. Okay, so it's 4,000 multiplied by 0.25. This is the expected value of the cash inflows. In the same way, we are going to calculate the expected value of cash outflows. So the first outflow in year 2 is 20,000 and its probability is 0.75. Plus the next one is 2,000. It's in minus, okay? Please be careful about the signs. And its probability is 0.25. So we are going to calculate the sum of these. Let's calculate it, Angelika. So first one, 16,000 multiplied by 0.15, it's 2,400 plus 12,000 multiplied by 0.60 is 7,200 minus 4,000 into 0.25 is 1,000. So expected value total of inflows is 2,400 plus 7,200 minus 1,000. It's 8,600. Now let's calculate the expected value of the outflows. 20,000 into 0.75. It is 15,000. And then 2,000 multiplied by 0.25. It is 500. So 15,000 minus 500 is simply 14,500. So this is the expected value of the outflows. Now 8,600 minus 14,500, and then we had initial the present value of the cash flow. Okay, these are not the cash inflows and cash outflows. These are the simple cash flow figures which have been given. Okay, Angelika, for year 1 and for year 2. So all of them are going to be calculated together. 8,600 plus 14,500 minus initial outflow of 12,000. So our answer is 11,100, Angelika. I was considering that the first column is for cash inflow. I just misunderstood. So both are cash inflows and outflows. Negative is cash outflow. Positive is cash inflow.
So we have to add everything and then minus the initial cost.
Initial one, yes. So this is the concept of expected values now. Got it, Angelika?
Yes, miss.
Okay, great. Angelika, give me a while, dear. Okay, dear. Now let's move on to the next question. Question number 96. Again, it's theoretical one. Okay, in relation to a long-term lease, which of the following statements is not correct? Angelika, there are two types of leases, short-term lease and the long-term lease. The common difference is that the long-term lease is for the period exceeding 50 years. And the basic difference between long-term and short-term lease is that the responsibility of the repairs and maintenance does transfer to the lessee. Okay, the person who is taking the lease, the responsibility for the repairs and maintenances does transfer to that lessee. This is again the difference between long-term and short-term lease. In the short-term lease, the responsibility for repairs and maintenance of the asset stays with the lessor. But in the case of long-term lease, it transfers to the lessee. So now let's see, in relation to the long-term lease, which of the following statements is not correct? All the risks and rewards of the of the ownership transfer to lessee. This is not right. All the risks, this is correct. Then all the risks and rewards of the ownership transfer to the lessee in the case of long-term lease. This is correct. The asset and lease obligation will be recorded in the statement of financial position. This is also correct. That the asset, leased asset, and the obligation, lease obligation, that is liability, will be recorded in the statement of financial position. Third one, the lease period will cover almost all of the leased assets' useful economic life. This is again correct. Most of the useful life of the asset will be covered by lease. This is correct. The last one, the lessor will be responsible for repair and maintenance of the leased asset. This is wrong. Who is responsible? Lessee.
The lessee, yeah.
Yes. Okay, now Angelika, question number 97. What is Pete's return on capital employed? ROCE. Do you remember the formula of return on capital employed?
Yeah, profit over capital employed.
And which profit do we take over here?
Before interest and tax.
Very good. That is operating profit. So the formula is profit before interest and tax, also known as operating profit divided by capital employed. And Angelika, what is capital employed? It is the sum of equity and non-current liabilities. Is it?
Yes.
Or it is total assets minus current liabilities.
Current liabilities.
Both the ways you can calculate the capital employed figure. Now, all the data is very straightforward. They have given us profit before interest and tax, and they have given us capital employed as well, equity and non-current liabilities. So the sum of equity and non-current liabilities is
12,500.
And our profit before interest and tax is 2,500.
2,500.
Divided by 12,500, it is 0.
20,
that is
20%.
Very good. So this is very simple. Okay, now question number 98, Angelika. Okay, calculate the initial return on capital employed for the project to the nearest whole percentage. Now, you are required to calculate return on capital employed, but it's an initial return on capital employed. Let's read the scenario. A company undertakes a project that involves purchasing machinery at the cost of 65,000. The machinery is used on the project for 5 years, generating operating cash inflows of 20,000 per year. It is sold at the end of the project for $10,000. Taxation is charged at the rate of 30%. And when in the exam you are going to encounter these type of the questions, they look very, very easy and very common. But there are small ideas or small concepts which you need to keep in your mind. Like over here in this question, the formula of return on capital is very easy to be applied. But the thing which you need to establish over here is that you need to calculate profit before interest and tax by yourself. And in order to calculate profit before interest and tax, the figure of depreciation is going to be deducted from the profits. Is it from the cash inflows? Cash inflow figure is 20,000. You need to calculate depreciation and you need to deduct it out of this 20,000. So what is the basic way to calculate depreciation? They have given us the scrap value as well, that is 10,000. Am I right? So cost minus residual value divided by estimated useful life of the project is depreciation. So as you can see that the machinery has been purchased for 65,000, scrap value is 10,000 divided by estimated useful life is 5 years. Now what simply students does, they do divide it with 5 years. But over here in examiner comments and in your book as well, the thing which they have concluded is that in the year of disposal, no depreciation is going to be taken. So 55,000 divided by 4 is going to be the amount of depreciation, not we are not going to divide it with 5 years. Have you got my point, Angelika?
Yes, miss.
The 5,000 minus scrap value is 10,000 divided by useful life. We are going to take 4 years instead of 5 because in the year of disposal, we are not taking any depreciation. So total depreciation is 13,750. So our profit will be cash flow of 20,000 minus depreciation of 13,750. Our profit will be how much, Angelika?
6250.
6250. Very good. And divided by capital employed, capital which has been employed initially is 65,000 into the machinery. So it is 9.6 and we have to round it to the nearest percentage, so it will become 10% because it's 9.6%. So if it's 5 and above, we can round it upwards. Clear, Angelika?
Yes, miss.
Okay, great.
Miss, so we don't have to do anything with the taxation.
Sorry?
They mentioned about the taxation, 30%.
Because yes, we have not considered taxation because in return on capital employed, we do take profit before interest and tax. So they have included the taxation only to confuse you.
Okay.
Okay, because we do take profit before interest and tax in return on capital employed. Okay, now the next question, question number 8. Now, Angelika, this is a type of objective test question. Do you know that you are going to have how many objective test questions in your exam? 3 objective test questions are going to come in this way. Okay, a scenario will be given to you, and like this, questions will be asked out of that scenario. So 3 OTQs are going to come for you in the exam. So one by one, you are going to read the requirement and then you will be reading the scenario. The first requirement is, what is Dink's money discount rate? Do you remember the Fisher's formula for money discount rate, Angelika? That will be given to you in the exam as well. That is 1 plus
I.
Very good. Is equal to 1 plus H into 1 plus R. So you are required to calculate money discount rate with the help of this formula. Then in the second part, you are required to calculate the present value of John's last payment that will be made in the 4 years' time. They are also requiring us what is the net present value of Marity's project. And last 2 are theoretical. So when you are going to see all the requirements of the question, you will come to know that you have to read the scenario in order to do full calculation. You have to calculate the net present value. When you will be calculating the net present value, all the previous questions are also going to be solved. So let's start calculating the net present value out of this scenario first. In that way, we will be able to calculate the money discount rate as well. We will be able to calculate the present value of the last payment also. Okay, Angelika? Let's start doing this question. Bell Company has decentralized and divisional managers are allowed to make their own investment decisions subject to the confirmation by the main company board. Because each of the three divisions are subject to different levels of risk, it has been thought appropriate to use different discount rates in each division. Okay. Dink has been told that its real discount rate is 5%. So Angelika, as you have encountered the information, you can write it as well. So first information, they have given us real discount rate. So in the formula, we can put the real discount rate. The general rate of inflation based on the index that uses a very wide range of prices is 2%. In the industry in which Dink operates, a number of prices are seen to be inflating at 3%. Now over here, Angelica, again, the point at which you can be confused in the exam is regarding the inflation rate. In the formula, are you going to use the general inflation rate or the specific inflation rate?
The specific one? No, wait, the general one.
No. In the Fisher's formula, in order to calculate the money rate, you will be using the general rate of inflation, that is 2%. Okay. So this again you have to focus upon. So in the formula, the inflation will be 2%. So now you can calculate the money rate as well. Is it? So 1.02 multiplied by 1.05 minus 1 multiplied by 100. It's 7.1%. The money discount rate is 7.1%. Angelika, are you clear about that?
Yes, miss.
Okay. Okay, now they say, Dong is assessing a project in which the first of 4 annual lease payments have been agreed at 120,000. This is payable in 1 year's time, and subsequent payment will rise by 4% per annum. Dink's proper money cost of capital is 8%. Okay, now you have calculated 7.1%. They are telling you that it's 8%. So to discount the cash flows, you will be using 8%. Okay? Okay, now, Merrily is considering investing 1 million in a project which will produce the following annual outflows and inflows. So they have given us outflows and inflows. They say the cash flow which arise at the end of each year are stated in current year terms. It is expected that outflows will rise by 3% per annum and inflows by 2% per annum. The money cost of capital of Merrily division is 9%. Now, Angelica, can you start calculating the cash flows? All the information is given to us.
Okay, yeah, miss.
You have to incorporate, yes, you have to incorporate the inflation into the calculations. Okay, so Angelica, what is your outflow for the year 1? They have given us an outflow as 1800. But what you are going to do?
We have to inflate it, right, Miss?
Yes, you are going to inflate it. So how much it will become?
Will be 1836
1836?
after inflating it
How
with
have you?
2%.
No, it's not 2%, Angelica, it's 3%. They are telling us in the industry in which DING operates a number of, towards in the last paragraph, it is expected that the outflows will rise by 3% per annum. Okay, so on outflows, it's 3%, 1800 into 0.03, 1.03 you are going to take, okay? It will become 1854, Angelica. Got it?
Yeah, Miss.
Okay, now Angelica, for year 2, how much it will be? Do you remember the formula of growth? Look, it was for year 1, 1800 into 1 plus 0.03 raised to the power 1, because we are trying to inflate it for year 1. Then for year 2, 2500 into 1 plus 0.03 raised to the power 2 now, because we are in year 2. Then for year 3, 1500 into 1.03 raised to the power 3 now. Got it, Angelica?
Yeah, Miss.
Now, Angelica, whenever they are going to tell you that we are stated in current year terms, from year 1, you are going to start inflating. Okay? Current year price or current year terms. Same effect you are going to do. Same you are going to do for the inflows now. For inflows, it is 2% per annum.
For year 1, it's gonna be 2040.
Very good.
And
For
then
year 2?
for year 2, it's going to be 3121.
Excellent. And for year 3?
It's going to be 2122.
Very good. Now you are going to calculate the net cash flows and you are going to calculate the NPV. And Angelica, together with these outflows, there is an initial payment as well. Initial investment is 1 million. Okay, so that you also need to consider.
Okay.
And which cost of capital are you, which discounting factor are you going to use, Angelica?
8%.
8%. But Angelica, they have given us the cost of capital, money cost of capital as 8%. And in the last line, you can see that the cost of capital for Merrily division is 9%. So why have you not used 9% and you have used 8% only?
Because 9 is for the Merrily one. The Merrily.
It is for Merrily.
Merrily.
Okay. So you have to consider as per the investment project in which you are investing.
Yeah.
Okay, not for our own division. Okay, sorry, Angelica. I'm sorry. This one, they are actually three divisions, Ding, Dong, and Merrill. That 8% is for Ding. We are going to consider for Merrill itself. The cost of discounting factor will be 9%. If we are assessing the project for Dong, then 8% will be used. Okay.
Okay, miss.
Got my point? Yes, actually these are three divisions, Ding, Dong, and then Merrill. For Merrill, it's 9%. We are actually appraising the project of Merrill. Okay, now Angelica, have you calculated the net present value?
$61,000.
Very good. And are you clear about that? If you are not clear about any point, do ask me, because this is the most favorable time, Angelica, to ask your query.
No, miss, it's fine. I just got confused with because there's like many, how do you say, like rates they gave, but like the topic is fine.
Okay. About which thing are you confused? Please tell me particularly. Let me make you clear about that.
No, I mean like in the question they gave like two different inflation rates.
Yes. Angelica, in the questions, you can expect different inflation rates to be given to you in your exam question. One is general inflation rate and one is specific inflation rate. Okay. What you have to do when you are calculating money cost of capital, in that one, you are going to use general rate of inflation. This is the first point. Okay. Then in your appraisal, you have to use money cash flows. Like you have seen that all the cash flows we have converted into the money cash flows. And the particular idea behind that is it's kind of what you can say. You can keep this point in your mind that when there are more than one inflation rates given to you, you will be converting your cash flows into the money cash flows. And you are going to discount them also using the money discounting factor. This is the second hint which you have to keep in your mind. Now, in this question, they are specifically telling you that the outflows are using the rise rate, the inflation rate of 3%, and inflows are using 2% per annum. They will be telling you clearly that the specific inflation rate for these costs is this much, and you are going to inflate those costs or your inflows according to those specific inflation rates. Okay.
Okay.
This is what we are going to do. Okay, now in the part B, we are not done with part B. What is the present value of Dong's last payment that will be made in 4 years' time? For Dong, Angelica, in the third paragraph of the question, you can see here from here it is starting. Dong is assessing a project in which the cost of 4 annual lease payments has been agreed at 120,000. This is payable in 1 year's time, and subsequent payments will rise by 4% per annum. Now, Angelica, again, you need to consider in investment appraisal, these things you need to consider, Angelica. They are telling that this 120,000, this is payable in 1 year's time, and subsequent payments will rise by 4% per annum. Now, in the first year, you are going to take only 120,000. In year 2, it will become 120,000 into 1.04, and then subsequently you are going to change it like this. Okay, so in the first year, the lease payment will remain 120,000. In year 2, it will become 120,000 into 1.04. It will become 124800. In year 3, it will become 129792. And in year 4, then it will become 134983. Is it, Angelica?
Yeah, miss, I got the same number.
Yes, 134984. Now, this is the 4th year payment about which they are asking, and that one you have to convert to the present value. Okay, present value of the last payment. So its future value is 134984. So simply you are going to see the discounting factor at what is the cost of capital for them? It's 8%. So in 8% column, you are going to see for a year. For which year? Year 4.
Year 4. Yeah, so 0.735.
0.735. Very good. So 134,983, or you are going to round it to 4. It multiplied by 0.735 will be your present value.
99,213.
99,000. Very good.
Yeah.
Okay. So like this, look, now in the exam about the things which you are going to be confused, I have clearly told you when they are going to give you the current year terms from initial, you are going to start changing it. In this 1800, you are going to incorporate the inflation. Okay. And how? 1800 for the first year into 1.03 raised to the power 1. Then 2500 into 1.03 raised to the power 2. Power also you have to change for exceeding years. And in this case, as they are telling you that this is payable in 1 year's time and subsequent payments are going to be rising. So in year 1 only 120,000 is going to be taken. Rise will be from year 2 on. Okay, now 2 theoretical questions are there as well. When considering a risk in project appraisal, what is the main advantage of using simulations to assist the appraisal? Now, one thing is simulation, Angelica. For simulation, and there is one more thing. One is simulation, and when there is only one variable under consideration. What is the other thing, Angelica? Do you remember about that? Can you recall the concept? Sensitivity analysis. Sensitivity analysis is going to be used when we do want the changings in one variable and we do want to see the outcome of that. When we do want to change different amounts of variables and see the effect of that in any project, we are going to use simulation. So they are asking us that what is the main advantage of using simulation to assist the appraisal? A clear decision rule? No, never. Neither sensitivity nor simulation never gives us a clear decision rule. B, more than one variable can change at a time. Yes, this is the major advantage of simulation in the case of investment appraisal, that we can change more than one variable to be changed at a time and we can see the effects of it. Then statistically more accurate than other methods, it's not correct. Being dramatic is easier to understand. No, it's complex basically. So option B is the right. Okay, then question E. Is it possible to have the negative real discount rate applied to the cash flows estimates made in the current terms when making investment decisions? Is it possible, Angelica, to have the negative discount rate? The initial thing which comes to our mind is that it can never be the negative one. But reality is that it can negative. It will be negative when the inflation rates in the country are going to exceed the money cost of capital. Okay, so in that case, it will be negative. So your answer is yes. And what is the reason for that? The last reason is the correct one. They say it will happen if the rate of inflation exceeds the money cost of capital. So this is just a theoretical part like this. In your exam questions also, there will be mix of the questions. Okay, some theoretical and some numerical. Okay. Now, Angelica, question number 11 is again that OTQ. It's again of the same manner. You are required to calculate NPV. So you can try it later. Let's do one long question also. One long question we are going to do. And question number 23 we will be doing. Question number 23. Let's see. This question we are going to do. The requirement of the question is, you can see, calculate the NPV of each option, estimate the internal rate of return. First, these two we are going to do, and the later two are theoretical questions. So we are required to calculate the net present value of each option and internal rate of return of each option. So let's start doing it. Let's start reading it. After securing an extension to an existing contract, the directors of dairy company are reviewing the options relating to a machine that is a key part of the company's production process. Option 1, replace the machine. Option 2, overhaul the existing machine. So we have two options, Angelica. And for these two options, we are required to calculate NPV as well as IRR. First, I would like to request you to start solving this question by yourself. If you get stuck at any point, you can ask me. Okay, Angelica? I think that is a more favorable approach. First,
Yeah,
you should
okay.
define by yourself. Yes.
Yeah.
Angelica, if you stuck at any point, you can ask me, dear.
No, miss, I'm doing it.
Okay. Okay, Angelica, what is an NPV for option 1? Angelica, are you there?
Yeah, miss, I'm here.
Okay, what is an NPV for option 1? Have you calculated?
Miss, they didn't give um the cost of capital. for option 1. How do we find it?
No, they must have given. It's not possible.
Oh wait, miss, is it 12%? I thought that was for the second option only.
No, no, no. Yes, in the last they have given. The financial manager is unsure of the cost of capital, but expects it around 12%. And the taxation can be ignored also, okay?
Yeah, I've only inflated the
Yes.
prices.
Angelika, what did you say right now?
I said that I inflated the prices because in the first, not the first line, but in option 1, it says that the payment is expected to rise by 7.5%.
Yes. So you are going to rise it by 7.5%.
Yeah.
It will be increased. Yes.
Yeah, I did that.
And again, Angelika, the first payment is 25,000. In the first year, it will remain 25,000. Later, it will start rising, okay?
Yeah, yeah.
And contribution is also given for the first and the second machine. Angelika, shall I do it with you or is it fine for you? You are doing it.
Almost done, miss. Just a second.
Okay, sure, sure.
Miss, is it 110,000 for option 1?
110,000. Very good, very good. And for option 2, have you calculated?
No, not yet.
Okay, calculate for second option as well for overhauling. Here, if you can see, because I have already calculated the NPV and IRR, for the first option, the NPV has been 110,024. For the second option, it's just 85,635. If on the basis of NPV we are discussing that whether the investment has to be selected or not, we will say that option 1 has to be selected since it is giving us higher NPV. Am I right? What is the decision criteria for NPV? If the present value is positive, we are in the mutually exclusive projects, we are going to go for the project with the higher NPV.
Higher, yeah.
So yes, so option A has to be selected. But if we do see IRR, if you can see IRR, both the IRRs are above the cost of capital. So if IRR is above the cost of capital, we can select it. But in case of mutually exclusive project, the one with the higher IRR has to be selected. It's 22.9 for project B, for option B. So if we do decide as per IRR, we should be going for option 2. Am I right? Because its IRR is higher as compared to option 1. But if we are exclusively trying to identify the project to increase shareholders' wealth, then we will be going for that particular project which is with higher NPV. So when the decision is to increase the shareholders' wealth, we have to decide as per the NPV, not as per IRR. Even if IRR for option 2 is higher, if we have to decide to increase the shareholders' wealth, we are going to go for the option which is with higher NPV. So we are going to go for option 1, that is having the higher NPV. Okay?
Okay.
So like this, we can interpret. Only for 3 marks we have to interpret. Now, question D, part B, they are asking explain different roles of Treasury Department and Finance Department in context of new investment and discuss the need for close liaison. Liaison is communication between the 2 departments. Now, as far as Finance Department is concerned, as regard to investment, Angelica, their task is to calculate the investment appraisal. They have to do the calculations regarding investment appraisal. They are going to do any kinds of forecasting regarding cost and revenue of the project. They are going to study and they are going to adopt different methods of appraisal. They are going to negotiate the terms of the contract with the supplier or with the other party. So these are going to be the duties of Finance Department. The calculations regarding investment appraisal, they will be doing, who will be doing? Finance Department.
Finance Department.
They will be adopting the better method of appraisal. Either they have to go with return on capital employed, NPV or IRR. And ultimately, they are going to negotiate the terms of the contract with the other party as well. As far as Treasury Department is concerned, they are going to select the suitable source of finance. Because finance is used for investment, so which source of finance has to be used, whether equity finance or whether debt financing. And in regards to that source of finance, they will be calculating the cost of capital as well. So cost of capital will be determined by Treasury Department and will be used by Finance Department in order to appraise the project. So that is the point where they have to be in close liaison with each other. Because if the cost of capital is not taken from the Treasury Department and Finance Department is appraising the investment project by their own cost of capital, the calculations are going to be wrong. So whenever, according to the risk, the cost of capital is going to be calculated by Treasury Department, it has then to be communicated to the Finance Department in order to appraise the project. So this is about the roles and responsibilities of the Treasury and Finance Department. So now, Angelica, these type of questions may do come in the exam, as you have seen. Now, there are 2 more long questions which I had added. They are of the same type scenarios. So you can practice them from your home together with the other questions in the revision kit. And I have sent the mock exam as well. When you do get the time, please start doing it also. Okay? And you can just send it to me on my email ID then. Okay, Angelica?
Yeah, miss.
So I hope that this revision has helped you.
Yes, miss, it's helped a lot.
Okay. So regarding investment appraisal, we have done few questions, but there are so many in your exam kit. I just request you to solve all of those. At least twice you should do the revision kit. Twice or thrice in order to get good marks, okay? So
okay, miss.
At the end of the lecture, if you do have any queries regarding today's session, you can ask.
No, miss, but on Tuesday, it will be the same time, right?
Yes, on the same time. For the same time on Tuesday, we are going to have the class again.
Miss, is it fine if we can make it like from 3 till 4?
Actually, for me, it's not a problem. For me,